Ladies and gentlemen, if you own gold or silver, this is not just another market update. This is a wake-up call. What I'm about to tell you could mean the difference between protecting your wealth and watching it evaporate in the coming months. Right now, the financial system is teetering on the edge, and silver, more than ever, is about to take center stage. You need to understand why the next moves you make could change your financial future forever. We are living in an era of unprecedented financial fragility. On the surface, the economy seems stable. Stock markets hover near all-time highs. Unemployment rates appear low, and consumer spending continues, at least temporarily, to prop up the illusion of prosperity. But beneath the surface lies a system teetering on the edge of disaster, held together not by strength or sound policy, but by increasingly fragile debt, artificial stimulus, and a faith in fiat currencies that are rapidly losing value. Most investors and citizens are blind to the growing cracks in the foundation. They assume that because the system has survived past crisis, it will somehow endure indefinitely. That assumption is dangerously wrong. At the core of this fragility is an unsustainable expansion of government debt. Around the world, countries have borrowed relentlessly, piling up obligations that grow faster than their economies. Interest rates have been artificially suppressed for years, making borrowing cheap and debt accumulation easy, but this is not a sign of economic health. It is a sign of systemic weakness. Debt, when used prudently, can stimulate growth, but the current levels of sovereign and consumer debt are extraordinary. They have created a global economy that depends on constant inflows of new credit to maintain its fragile balance. The moment interest rates rise or credit growth slows, the system could buckle under its own weight. The global banking system is another point of vulnerability. Banks operate on leverage, using borrowed money to fund loans and investments, often with very thin capital buffers. When asset prices fall or liquidity dries up, these institutions can face insolvency almost overnight. History shows that banking crises tend to spread rapidly, creating a domino effect that ripples through every corner of the economy. Yet regulators have largely relied on temporary fixes, bailouts, and promises of too-big-to-fail protections rather than addressing the root causes. The result is a financial sector that appears robust on the surface but is highly sensitive to shocks. Adding to the fragility is the reliance on fiat money. Governments have the power to print currency at will, and they have used that power extensively in recent years. While this may provide short-term relief, it erodes trust in the currency over time. Inflation, often hidden in subtle ways, diminishes purchasing power and penalizes savers. Citizens are encouraged to spend and borrow rather than save because holding cash becomes increasingly unwise. This dependence on artificially maintained currency value creates a delicate balance. Any misstep in monetary policy, any loss of confidence could trigger rapid and destabilizing inflation or a currency collapse. Global trade and supply chains, often viewed as a source of economic strength, also contribute to systemic vulnerability. Modern economies are highly interconnected, and disruptions in one region can cascade worldwide. A natural disaster, a geopolitical tension, or economic policy mistake in one key region can halt production, inflate prices, and create shortages that ripple across industries. The dependence on fragile supply networks makes even minor disruptions potentially catastrophic. This interdependence magnifies the effects of financial instability, turning localized problems into global crisis. Another critical factor is the mispricing of risk. Investors and policymakers have been lulled into complacency by years of low interest rates and accommodative monetary policy. Risk has been underestimated, and many financial assets are now priced for perfection, assuming continued growth and stability. The slightest shock, a sudden rise in interest rates, a default, or an unexpected geopolitical event could trigger panic selling and massive losses. Markets that appear calm today are often the most dangerous. precisely because they are built on unrealistic expectations. What is particularly alarming is the widespread lack of financial literacy and preparedness among individuals. Many people live paycheck to paycheck with minimal savings or tangible assets. They rely on government promises, pensions, or the assumption that their investments in the stock market will continue to grow indefinitely. When a systemic crisis occurs, these individuals are the most vulnerable, lacking both the understanding and the resources to weather a storm. The fragility of the economy is mirrored in the fragility of personal finances. Ultimately, the fragility of the global economy is the result of a combination of excessive debt, over-reliance on central bank interventions, fragile banking systems, mispriced risk, and global interdependence. The system is like a building constructed on sand. It may stand for a while, but it is inherently unstable, and a single shock can trigger widespread collapse. Those who fail to recognize the vulnerabilities and prepare accordingly risk losing not just wealth, but security and peace of mind. Yet there is a way to navigate this environment. Recognizing the fragility is the first step. Understanding this at the apparent stability is an illusion allows individuals and institutions to position themselves wisely. Diversification, tangible assets, and an awareness of macroeconomic trends are essential for protecting wealth. The financial system will not remain fragile indefinitely. At some point, it will either adjust through deflationary collapse, currency devaluation, or some combination thereof. Those who act before the crisis arrives will be far better prepared than those who remain complacent. In conclusion, global economic fragility is not a distant theoretical concept. It is a current pressing reality. Debt, currency debasement, fragile banks, overextended supply chains, and mispriced risk all converge to create a system that is vulnerable to shocks. Ignoring these warning signs is dangerous. Understanding them, preparing for them, and acting proactively is the only way to safeguard wealth and stability in a world built on fragile foundations. The time to recognize this reality and respond is not after the crisis hits, but before it unfolds. Silver is one of the most misunderstood and overlooked assets in the world today. While gold often dominates headlines, investor portfolios, and financial commentary, silver quietly trades at a fraction of its true value relative to its scarcity, industrial demand, and historical price relationships. Most investors fail to grasp just how severely undervalued silver has become, and that ignorance could prove costly in the coming years. To understand silver's undervaluation, one must first consider its historical ratio to gold. For decades, silver has traded at a ratio of roughly 15 to 1 against gold, meaning 15 ounces of silver would equal 1 ounce of gold in value. Today, that ratio has ballooned far beyond historical norms, reaching levels not seen in decades. Such divergence is not normal or sustainable. Markets tend to carry extremes. When the ratio eventually normalizes, silver is positioned to experience a dramatic price increase far outpacing gold on a percentage basis. Part of silver's undervaluation lies in its dual nature. It is both a precious metal and an industrial commodity. Unlike gold, which is primarily hoarded for wealth preservation, silver has widespread industrial applications. It is used in electronics, solar panels, medical equipment, and countless other essential technologies. The growth of industrial demand has accelerated in recent years, particularly as the world shifts toward renewable energy and digital infrastructure. Yet despite this growing demand, the price of silver has remained stubbornly low, indicating a significant disconnect between its actual utility and its market valuation. Supply constraints further amplify silver's value proposition. Unlike paper assets or fiat currency, silver cannot be created at will. Mining production is limited and existing reserves are finite. Many silver mines are aging and face rising costs and technical difficulties, which limits their output. At the same time, recycling alone cannot satisfy industrial and investment demand. When you combine constrained supply with growing demand, the stage is set for a supply-demand imbalance that could trigger significant price appreciation. Moreover, investor perception plays a major role in silver's undervaluation. Many investors are focused almost exclusively on gold as the safe haven, ignoring silver's potential. The general public often views silver as merely a secondary asset suitable only for small investors or collectors. This perception has created a paradoxical situation. Silver is both undervalued and underowned, yet it remains highly liquid and globally recognized as a store of value. Once the market begins to recognize silver's real worth, price spikes could occur rapidly, catching those who have ignored it completely off guard. Monetary policy also contributes to the undervaluation of silver. Central banks around the world have printed unprecedented amounts of money, devaluing fiat currencies and pushing up asset prices across the board. While gold has responded to this monetary inflation, silver has lagged behind, creating a distorted market opportunity. Historically, silver has tended to outperform gold in inflationary periods because it is more accessible to a wider range of investors and speculators. Yet today, that historical relationship has been disrupted, presenting a rare window for those who understand the dynamics. Another factor is the psychological bias of investors. Silver has been subject to manipulation and market distortion for decades, which has dampened confidence and caused many to dismiss it as a speculative or volatile asset. But what is perceived as volatility is often simply a reflection of illiquidity and temporary market sentiment. The underlying fundamentals, scarcity, industrial use, and long-term demand remain incredibly strong. When the perception shifts, silver could experience a dramatic upward repricing. The timing is particularly crucial now. Global economic instability, rising inflation, and currency debasement all point to a scenario where tangible assets will outperform paper assets. Silver, due to its extreme undervaluation and dual role as both commodity and monetary metal, is uniquely positioned to benefit those who fail to recognize this undervaluation, missing a generational opportunity. Waiting for prices to rise naturally could mean entering the market after much of the upside has already been realized. Finally, silver is not merely an investment. It is a hedge against uncertainty. In an era of fiat currency devaluation, banking instability, and geopolitical tension, holding physical assets that cannot be created or manipulated at will provides a critical layer of protection. Gold serves this purpose as well, but silver offers the advantage of accessibility, affordability, and historically explosive upside during periods of systemic stress. Its undervaluation relative to both gold and its industrial utility makes it one of the most compelling opportunities in the modern financial landscape. In conclusion, silver is severely undervalued. Its historical ratios to gold, industrial demand, constrained supply, and general market neglect all point to an asset poised for significant appreciation. Those who ignore silver today are ignoring one of the few tangible wealth preservation opportunities left in a world of increasingly fragile fiat currencies. The gap between perception and reality is vast, and when the market finally corrects, silver could move far more aggressively than many anticipate. This is a rare moment in financial history. The undervaluation is glaring, the fundamentals are strong, and the catalysts for a dramatic price increase are already in motion. Understanding this reality and positioning oneself accordingly is not merely prudent. It is essential. The stage is set for an impending surge in silver prices, and the warning signs are becoming impossible to ignore. For years, silver has been overlooked and undervalued, trading at historically low levels relative to gold and failing to reflect its growing industrial and investment demand. But the forces that have kept its price suppressed are beginning to shift, creating the conditions for a significant and rapid price increase. Those who fail to recognize this trend risk being left behind, while those who act decisively stand to benefit enormously. To understand why a price surge is imminent, one must consider the fundamental imbalance between supply and demands. On the supply side, silver faces severe constraints. Many of the largest silver mines are aging, extraction costs are rising, and new discoveries are limited. Mining output has struggled to keep pace with growing demand, which comes not only from investors but also from industrial applications. Silver is critical in electronics, solar technology, medical devices, and a range of other essential industries. This combination of constrained supply and expanding demand creates an environment in which even modest increases in investment or industrial consumption can trigger significant upward pressure on price. At the same time, monetary policy around the world has devalued fiat currencies, eroding purchasing power and creating an urgent need for tangible assets. Central banks have printed unprecedented amounts of money and interest rates have been historically low for years. While these policies have temporarily stabilized markets and encouraged borrowing, they have also set the stage for inflationary pressures that threaten to destabilize the economy. Historically, periods of currency devaluation and high inflation have corresponded with sharp increases in the price of silver. Unlike paper assets, silver cannot be created at will, making it one of the most effective hedges against monetary erosion. Investor behavior also signals an imminent surge. Many institutional and retail investors have begun to recognize silver's undervaluation relative to gold. Hedge funds, ETFs, and other large-scale players are quietly accumulating silver, while retail demand for physical coins and bars is increasing. These trends are often early indicators of larger price movements, because once momentum builds, the market can move quickly and dramatically. Unlike gold, which is already well-owned and widely recognized, silver has a smaller base of investment demand. The smaller base means that price moves can be more extreme once investors begin to reposition their portfolios. Historical patterns further support the case for a surge. Silver has traditionally outperformed gold during periods of systemic financial stress or sharp currency devaluation. It is more accessible to a wider range of investors and has been subject to periods of rapid appreciation when global economic conditions deteriorate. Looking back over decades, silver has exhibited volatile but explosive growth during the early stages of financial crisis, often far outpacing other asset classes. The current economic climate with mounting debt, fragile banking systems, and currency debasement mirrors those historical conditions. This is not a speculative guess. It is a pattern that has repeated itself, and all the indicators suggest it is about to happen again. The timing of the surge is particularly critical. Market signals indicate that silver may be on the verge of breaking out from its long period of underperformance. Ratios between gold and silver are at historically extreme levels. Industrial demand is rising and macroeconomic instability is increasing. Investors who wait for confirmation may find themselves entering the market after a significant portion of the upside has already been realized. In other words, hesitation could mean missing one of the most significant wealth preservation opportunities in decades. Those who understand the fundamentals and act preemptively will be well positioned to benefit from the surge, while those who ignore the warning signs may be left scrambling. Global economic instability adds another layer of urgency. Geopolitical tensions, rising government debt, and the threat of inflation all point toward a scenario in which tangible assets like silver become increasingly attractive. Markets tend to move in anticipation of crisis rather than in reaction to them, meaning that the price of silver could rise well before the worst effects of economic instability are felt. This anticipatory nature of markets magnifies the potential for rapid gains, and savvy investors recognize that positioning oneself early is critical. It is also important to understand the psychological dimension. Silver has been underestimated and overlooked for years, which means the market is underpricing its true value. Once the reality of scarcity, industrial demand, and economic risk is widely acknowledged, a rush of buying could occur. This kind of market psychology can amplify price movements, turning what might otherwise be a steady increase into a sudden and dramatic surge. History has shown that when the crowd finally wakes up to the value of silver, prices can move very quickly, catching the unprepared off guard. In conclusion, all the factors point to an impending surge in silver prices: constrained supply, rising industrial demand, undervaluation relative to gold, monetary debasement, historical patterns, and market psychology all converge to create a scenario where silver is poised for significant gains. The warning is clear. Ignoring this opportunity could mean missing out on a major wealth preservation and appreciation event. Those who recognize the signals, understand the fundamentals, and act decisively will not only protect their wealth, but may see extraordinary upside. The time to prepare is now before the market fully grasps what is already underway. Silver's moment is approaching, and those who are ready will benefit the most. In today's economic environment, protecting wealth is no longer optional. It is essential. The financial system that most people trust, including central banks, governments, and the stock market, is increasingly fragile every day. Policies meant to stabilize the economy are actually eroding the value of wealth, and failing to act now could result in irreversible losses. Those who understand the dynamics at play recognize that tangible assets, particularly precious metals like gold and silver, are not merely investments. They are shields against an impending financial storm. The question is no longer whether to act, but how and when. The first step in protecting wealth is understanding that fiat currencies are under assault. Governments have long relied on printing money to fund deficits and stimulate economic activity, and this has only accelerated in recent years. Every dollar, euro, yen, or other paper currency in circulation is subject to devaluation. Inflation may appear subtle at first, often masked by manipulated statistics or temporary market stability, but the real impact on purchasing power is undeniable. Savings held in cash, checking accounts, or bonds are eroding quietly but steadily. Those who fail to recognize this are effectively losing wealth day by day. Investing in tangible assets is critical because they cannot be printed or devalued artificially. Gold has long served as a store of value, and silver, though often overlooked, is equally vital. Silver is unique because it is not only a store of wealth, but also an industrial commodity with real-world demand. This dual role magnifies its value during periods of economic instability. Owning physical precious metals provides protection against currency devaluation, market crashes, and systemic risk. But merely owning them is not enough. Timing and accumulation strategy are key to maximizing protection and potential gains. Diversification is another crucial component. Wealth preservation cannot rely solely on one asset or market. While precious metals should form the foundation of a defensive portfolio, other tangible assets such as real estate can offer additional protection against inflation and currency risk. Similarly, investments in sectors that benefit from economic disruption, like energy, essential commodities, or defensive industries, can provide stability when traditional markets falter. The goal is not speculation. It is creating a fortress of assets that can withstand shocks while preserving purchasing power. Strategic accumulation is vital. Precious metals and other defensive assets should not be acquired haphazardly or impulsively. Instead, investors must study market trends, historical price patterns, and macroeconomic signals to determine optimal entry points. Buying in phases rather than attempting to time the absolute bottom can reduce risk and increase long-term returns. Patience is critical because the value of these assets often appreciates slowly at first and then accelerates sharply once market awareness grows or systemic pressures mount. Those who wait too long may face higher prices or diminished opportunity. Liquidity is also an essential consideration. While holding physical assets is critical for protection, accessibility matters in times of crisis. Investors should ensure that a portion of their holdings can be readily converted or used if needed without being trapped in illiquid investments. Silver, in particular, offers this advantage due to its smaller denomination, ease of storage, and wide acceptance. This liquidity ensures that wealth is not only preserved, but remains functional, allowing individuals to respond to emergencies, seize opportunities, or navigate financial disruption. Education and vigilance are equally important. Understanding the risks inherent in today's financial system allows investors to anticipate shifts rather than react to crisis. Both monitoring central bank policies, government fiscal behavior, and global economic trends provides insight into potential triggers for market volatility. Awareness empowers individuals to make informed decisions rather than relying on hope or the promises of institutions whose interests may not align with those of the average investor. In a fragile economic environment, knowledge itself becomes a form of protection. Psychology and discipline cannot be overlooked. Protecting wealth is as much about mindset as it is about strategy. It requires resisting the temptation to chase short-term gains or follow market fads and instead focusing on long-term preservation. Fear and greed are powerful motivators that often lead investors to make poor decisions at the worst possible time. A disciplined approach grounded in tangible assets, historical precedent, and macroeconomic awareness provides the clarity needed to act decisively when necessary. Ultimately, protecting wealth in today's economy is about preparing for what most people refuse to see. Markets, currencies, and governments may appear stable, but they are underpinned by structural fragility that is intensifying every year. Tangible assets, diversification, strategic accumulation, liquidity, education, and discipline together form a comprehensive approach to safeguarding financial security. The opportunity to act is now before systemic pressures fully manifest. Waiting too long or relying on conventional financial assumptions is a risk that many cannot afford. In conclusion, the path to protecting wealth is clear, but it requires action. But that holding cash or relying solely on traditional financial instruments exposes individuals to erosion, instability, and loss. Physical assets, particularly precious metals, provide both a shield and a foundation for future growth. Accumulating these assets strategically, diversifying intelligently, maintaining liquidity, and staying informed are not optional. They are essential steps for anyone serious about preserving their financial future. The time to prepare is now before economic reality forces the decisions upon you. Acting decisively today ensures that wealth is not only protected but positioned to thrive in the uncertain future that lies ahead. So here's the bottom line. The financial world is unstable. Currencies are being devalued and the clock is ticking. If you own gold or silver, you cannot afford to ignore this moment. The coming surge in silver prices could be historic. Position yourself wisely. Act decisively and make sure your wealth survives and even thrives in the storm that's approaching. Remember, this is not just investing. This is protecting your future. The time to act is now.